Safe harbor is a guarantee from the IRS. Pay this amount across these 4 installments, and they cannot charge you an underpayment penalty regardless of what you actually owe in April. The guarantee is in the tax code. 2 formulas qualify. One of them is usually better for your situation, and the difference between them is the threshold where prior year AGI crossed 150,000. The penalty itself is small in dollar terms, but the discipline of safe harbor isn't about the penalty. It's about the protection it gives you to ignore in-period income tracking entirely and still land safe in April. Pay this amount in these 4 installments, and the underpayment penalty does not apply to you, regardless of whether you owe $20,000 or $100,000 in April. The IRS's position is that you've shown a good faith effort to settle the obligation in installments, and the difference between what you paid quarterly and what you actually owe in April is settled at filing without penalty. The behavioral implication is significant. You don't have to track quarterly income, recompute your expected tax rate every 3 months, or stress about underwithholding. You compute the safe harbor number once at the start of the year and pay it on autopilot. 3 formulas, and the right one depends on prior year AGI and on whether you have a prior year at all. 1. 100% of last year's federal tax liability, which is line 24 of last year's 1040, divided into 4 equal installments. 2. 110% of last year's federal tax divided by 4, which kicks in when prior year AGI exceeded 150,000 for single filers or married filing jointly. 3. 90% of current year actual tax divided across 4 quarters, which is the only option in year 1 when there is no prior return to anchor against. Formula 2 catches higher income coaches who don't know the threshold and end up underpaying by 10%. Selection logic by situation, because the right formula isn't the same in every year. Year 1 with no prior return, 90% of current year estimate is the only option, and the estimate has to be honest. Income growing year over year, the prior year formula undershoots the actual bill but still protects you from penalty. You'll owe a larger balance in April but no penalty added. Income declining year over year, the prior year formula overshoots and you get a refund in April, or you can switch to 90% of current to keep the cash flowing through the year. The penalty protection is the constant. The cash flow shape is what differs. The underpayment penalty math is small, but small times preventable equals avoidable. The penalty is federal short-term rate plus 3 percentage points, adjusted quarterly, and prorated for the period during which the underpayment existed. At typical rates over the last few years, that's 7 to 8% annualized. A $5,000 underpayment that sits for 6 months runs about $175 to $200 in penalty. Not catastrophic, entirely avoidable through safe harbor. The reason to care isn't the penalty dollar amount, it's the discipline. The same setup that eliminates the penalty also eliminates the April surprise. Here's how the 2 safe harbor options shape the cash flow differently when the year is growing. Year 1 tax, $12,000. Year 2 projected, $16,000. Option A, prior year safe harbor. Pay $3,000 per quarter, $12,000 total across the year. April balance due is $4,000. No penalty. Cash flow tighter through the year, larger balance in April. Option B, 90% of current, pay $3,600 per quarter, $14,400 total across the year. April balance due is $1,600, no penalty. Cash flow heavier through the year, smaller balance in April, Same protection, different distribution, pick on cash flow preference, not on penalty risk. Most income tax states have their own safe harbor rules, and they don't all mirror the federal version. Some states accept 100% of prior year state liability divided by 4, parallel to the federal structure. Some require a percentage that differs from the federal rule. A few use 90% of current year as the only protection. The quarterly estimated tax worksheet linked to this unit flags the most common state variations, but the authoritative source is your State Department of Revenue's instructions for that year. Don't assume the federal pattern carries. Verify the state rule before relying on it for penalty protection at the state level. Before you leave this video, compute your safe harbor number and check whether you're on track. If you have a prior year tax liability, take 100% of it, or 110% if prior year AGI crossed 150,000, and divide by 4. That's the per quarter floor that keeps you penalty safe for the year. Compare against what you've already paid this year through your quarterly schedule. If you're behind by even a small amount, the next quarterly payment is where you make it up. The combined safe harbor amount across all 4 payments by January 15th of next year is what triggers the protection, not the individual per payment number.